94 ETFs. That's how many Fidelity offers right now. Most people pick one or two of the popular ones and call it a day. Nothing wrong with that. But it means they're ignoring more than 90 other options on the same platform. In this video, I'm testing all 94 Fidelity ETFs. Bonds, sectors, factor funds, dividend ETFs, actively managed funds, international funds, and a couple of oddballs that don't fit anywhere else. I took $10,000 and ran it through every single one, then ranked them all and found a winner in each segment. And at the end, I'll show you the Fidelity ETF that turned $10,000 into over $80,000 in 10 years. Plus a second fund that came in number 2 overall, beating every sector except one, beating every dividend fund, beating every active fund, and barely anyone has it in their portfolio. Analyzing 94 ETFs sounds simple when I say it out loud, but in practice, it is a nightmare. I'd be opening a dozen tabs, copying numbers from each one, building a spreadsheet by hand, hoping I didn't fat finger a single digit. It's a week of work, easily. So I went a different route. And the only reason this video exists in its current form is today's sponsor, Investing.com, the world's leading financial information website. I'm currently an Investing Pro member, their flagship product, which has a strong set of features for analyzing stocks and ETFs, specifically their Investing Pro platform. Let me show you how I use this tool and how I researched this video. This is the Investing.com website. In the top right menu, there's a tab called Investing Pro. This is basically a giant database of every public investment on the planet. Stocks, ETFs, mutual funds, around 148,000 of them in total, and you can filter them however you want. And the screener is where you start. This is where the real work happens. So I opened the screener. First thing I do is in the Assets That Match column, I select Asset Type ETF. That narrows the list to just exchange-traded funds. Second, in the Filters section, let's type Fund Issuer. And on the right, let's search and select Fidelity. And there it is, 94 funds, every Fidelity ETF on the planet sitting on one screen. But hold on, 94 is a little misleading. Some Fidelity ETFs are cross-listed, same fund, different exchange, which means without filtering, I'd be running the same fund through the test twice. So I toggle primary trading item on, and 94 drops to 58. That's the real list. Now, you can also build a custom view of metrics that you want for your research by simply clicking Add View. For this Fidelity list, I have a pre-built view of metrics like expense ratio, overall health score, 10-year return, 1-year return, and a couple more. Everything I need side by side. No confusing tab switching. And you can simply export it all to Excel or Google Drive. While I'm in here, Investing Pro does a lot more than just the screener. There's Warren AI, an AI chatbot built specifically for investing questions. You ask it something about a stock, you get a research-based answer. There's ProPicks AI, AI-curated stock picks across different strategies updated regularly. So if you're looking for ideas, that's a good place to start. And once you click into any individual stock, this is the part I use the most, you get a full breakdown. There's a financial health score, color-coded so you can tell at a glance whether the company's balance sheet is actually healthy or not. There's fair value, one number telling you whether the stock is overpriced, fairly valued, or actually on sale right now. If you want to try it, Investing.com has a discount live right now, but if you use the first link in the description or in the pinned comments section, add my code at checkout, John's Money Adventures, and get an extra 15% on top of any promotion they have on their site. Okay, so back to the 58 Fidelity ETFs. This is what came out of Investing Pro. Raw data, every fund listed, 10-year cumulative returns, 1-year returns, expense ratios, all of the columns we set up. Now, to make things move quicker and to make it all easier to understand, I've cleaned up and arranged the data into this sheet. Same 58 funds, sorted into segments. 10-year cumulative returns converted into CAGR. That's just average annual return, how much a fund made per year on average. Then a $10,000 column so you can see what the money would look like today. Same starting amount. Let's see what happened. Here are the rules. $10,000 into each fund. 2 time frames. The 1 year shows what happened in the last 12 months. The 10-year shows what happened across the whole decade. Rate hikes, the COVID crash, the recovery, the AI boom, everything. The 10-year number is what crowns the winner in this video. 1 year can be a fluke. 10 years is a pattern. Now, 2 of these 58 funds launched after 2020. They don't have a full 10-year history yet, so they'll show up in their segments with an asterisk, but they can't take the crown. 10 years of history is the entry fee. All right, first up, bonds. 6 of the 58 are bond funds. And look, I realize nobody clicked on this video to hear about bonds, but they're part of the 58, so they're part of the test. The 10-year winner here is FDHY, the Enhanced High Yield ETF. $10,000 turned into $15,649, a 4.58% average annual return. And look, FDHY is technically a bond fund, but it holds high-yield bonds, which means bonds from companies with lower credit ratings. So higher risk, higher yield, that's how it beat the rest. The bottom, FCIG, the Global Investment Grade Bond ETF. $10,000 became $10,080. 10 years, $80 of growth. That's not a typo. And somewhere in the middle sits FBND, Fidelity's big total bond ETF, the one most Fidelity bond investors actually own. It delivered $13,193 over the decade, roughly 2.8% per year. Here's why. The last 10 years included one of the most aggressive rate hike cycles in decades. When the Fed raises rates, existing bond prices drop. Short-term bonds recovered faster. They mature quickly and roll into higher rates. Long-term bonds got stuck with low rates for years. FBND holds a mix of everything, and the mix got dragged down. The 1-year picture is similar. FDHY still leads at 11.7%. FCIG still trails at 2.8%. Bonds are bonds. No dramatic flips here. The whole segment sits between $10,080 and $15,650, a spread of about $5,500 over a decade. And you'll see why that matters in a second, because the next few segments have spreads of $50,000 or more inside a single group. Bonds preserved capital. They didn't grow it, and no bond fund is in the race for the crown. Now, let's look at a segment most U.S. viewers didn't even know Fidelity had. 8 of these 58 funds aren't even listed in the U.S. They're Canadian. Canadian dollars, Canadian exchange. Most viewers watching this can't even buy them on a normal U.S. brokerage account, but Fidelity made them, so they're in the test. Let me start with the asterisk funds. FCZV, Fidelity Canadian Value. This one put up 17.81% per year, but only over 5 years. It launched after 2020. So it's in the table, but it can't take the crown. $10,000 turned into $22,694 in 5 years. FCIQ, International High Quality. Same deal. Launched late, can only show 5 years, 6.59% per year. Now, the real 10-year winner. FCUV, Fidelity U.S. Value Canadian Listed. 12.48% per year, $32,416 from $10,000. Here's the twist. Notice the top performers in this segment: FCUV, FCVH, FCUQ, FCQH. All of them are Canadian listed versions of U.S. investment strategies, not actual Canadian companies. Fidelity built these for Canadian investors who want U.S. exposure without the currency exchange. They work. They've worked well, but U.S. viewers can't touch them. The bottom of the segment, FCIQ again, at roughly 6.6%. Still beat the bond funds, but the weakest in this group. If you look at the one-year return, FCCV at 54.1%, best in the segment. Canadian value stocks had one of their strongest years in a decade. But check what jumped up the rankings. FCCQ, the Canadian High Quality Fund at 43.7%. FCIV, the International Value Fund at 41.7%. The funds tracking actual Canadian and international companies, the ones that lagged for 10 years, sat at the top of the one-year board. And the funds that won the decade, FCUV at 38.6%, FCVH at 37.9%, still strong numbers, but knocked down to the middle of the pack. Here's what that flip is telling us. For 10 years, U.S. stocks crushed everything outside the U.S. That's why the Canadian-listed U.S. strategy funds dominated. But over the past 12 months, the rest of the world started catching up. Cheaper valuations, stronger local currencies, money rotating back into international markets. The decade winner was U.S. exposure. The year winner was anything but. Okay, so that's 2 segments down, 5 to go. And at the end, I'll show you the Fidelity ETF that turned $10,000 into over $80,000. And a second fund, one of its kind, that came in second place overall, beat every sector except one, beat every dividend fund, beat every active fund, and barely anyone has it in their portfolio. But first, let's look at the thematic segment. There's one fund in this segment, just one, FCPI, Fidelity Stocks for Inflation, built for one specific purpose, holding up when inflation runs hot. It picks stocks that historically did well during high inflation periods, consumer staples, energy, real assets, things people buy regardless of prices. 10-year CAGR, 9.02%. That means $10,000 turned into $23,717 and a one-year return of 30%. It beat every bond fund combined. It beat several sectors across a decade that included one of the worst inflation stretches in 40 years. Nobody talks about it, but it held up. Next is the actively managed equity segment. For 20 years, the data has said the same thing. Passive index funds beat active management. Lower fees, less work, better long-term returns. Real quick, active management means a real person picks the stocks instead of the fund just tracking an index. Higher fees, more work, and usually worse results. That's what the data says. But one Fidelity active fund broke the rule. FBCG, Blue Chip Growth, actively managed, 11.13% per year. $10,000 turned into $28,729 over a decade. That's bigger than every Canadian-specific fund over the past 10 years, and it charges a 0.6% expense ratio, 6 times what most Fidelity Index ETFs charge. So you're paying more, and you're getting more. That's not how this usually plays out. The middle of the segment, IPGR and FUSR, delivered roughly 9 to 10% per year. Solid, but not spectacular. The bottom, FYER, Emerging Markets Equity Research Enhanced, 3.24% per year, $13,756 from $10,000. Now look at the one-year picture. FBCG holds its position, 53.3% in 12 months. Still number one in the segment. It won the decade, it won the year, the only active fund that did both. Look at what moved. FYER, the Emerging Markets Equity Research Enhanced Fund. It sat dead last on the 10-year ranking at 3.24% per year. On the one-year ranking, it jumped to second place at 46.8%. Emerging markets had one of their strongest years in a while. And look at what fell. IPGR, the Global Focus Fund. Number 2 on 10 years, number 8 on 1 year. Same fund, completely different story depending on when you measure. That's the active management trade-off in one segment. When the rally fits your style, you win. When it doesn't, you pay fees for worse returns. FBCG just happened to fit both time frames. So active beat some of the indexes. Now, what about the segment everyone associates with playing it safe? Dividends. There are 13 dividend funds, Fidelity's largest category by count. 3 U.S. listed, the rest spread across Canadian and European exchanges. Real quick, Fidelity built a parallel European product called Quality Income. Same playbook as the U.S. dividend ETFs, same strategy, different exchange. It's all the same company. That's why you'll see funds like FUSD and FGQI in the list. Those are European variants. The 10-year winner is FDVV, Fidelity High Dividend ETF, 12.58% per year. $10,000 grew to $32,705. Right behind it, FDRR, Dividend ETF for rising rates, 12.53% per year, $32,560. The two are basically tied. Now here's the thing, FDVV beat every bond fund, beat every international fund, beat every active fund except FBCG, a high dividend ETF competing with growth funds and almost winning. The European Quality Income variants, FUSD and FGQI, landed around 10 to 11% per year. Solid, but lower than the US listed versions because of currency drag and fee structure. The bottom, FCMI, Canadian Monthly High Income, 4.21% per year, $15,104 from $10,000. Now look at the one-year picture. This is the biggest flip in the entire video. FYEM, the Emerging Markets Quality Income Fund. It sat at number 10 on the 10-year ranking, near the bottom, 5.91% per year. On the one-year ranking, number 1 in the segment at 48.8%. It jumped 9 spots to the top. Emerging market dividend stocks had a massive year. Cheap valuations, strong local currencies, and renewed investor interest after years of underperformance. And look what FDVV did. The 10-year winner, 12.58% per year for a decade. On the one-year ranking, it dropped to 9th place, 29.4%. Still a respectable number, but compared to FYEM at 48.8%, nowhere near. And overall, FDRR was able to hold its podium. So that's 5 segments down. We've got 2 to go. Now, in one of these last 2 segments, we'll find the fund that pulled off the biggest run in this video, over 8 times the money in 10 years. We'll also discover the fund that came in right behind it, a fund that rarely makes it onto a single investor's radar. Both winners, both in the final 2 segments. Let's keep going. Next up, factor funds, the segment most viewers have never even heard of. So this one's different. Most of you watching have probably never heard of factor ETFs. Here's the short version. Instead of tracking an index like the S&P 500, these funds pick stocks based on a specific trait, like momentum, stocks that have been going up, value, stocks that look cheap, quality, companies with strong balance sheets, low volatility, stocks that don't swing much. It's like putting a filter on top of the whole market. Fidelity has 9 of these funds. The 10-year winner is FDMO, Momentum Factor, 14.41% per year. $10,000 turned into $38,427. FDMO beat every dividend fund, beat every active fund, including FBCG. The only sectors that beat FDMO were tech. The cluster behind it, FQAL, quality, FVAL, value, FDLO, low volatility, all landed between 12% and 13.5% per year. Pick whichever trait you believe in, you've got roughly this same outcome. Now look at the bottom. FIVA, FDEV, FDEM, International Value Factor, International Multi-Factor, Emerging Markets Multi-Factor, 5.7 to 6.7 per year, roughly half the U.S. factor numbers. This shows the factor approach worked great in the US. Outside the US, it mostly didn't. As for the one-year picture, FDMO stays at number 1, 42.7% on the year, held the crown on both timeframes. FDEM, dead last on 10 years, jumped to second on 1 year, 42.5%. The emerging market factor approach finally caught a tailwind. FIVA, International Value Factor, also jumped from 7th to 3rd. And look at what dropped. FDLO, low volatility, went from number 4 on 10 years to dead last on 1 year. Low volatility stocks lag in rally years. They're designed to. The 10-year told you which traits worked. The 1 year tells you which traits caught the recent rally. FDMO is one of the few funds that did both. Finally, the last segment, sector ETFs. Fidelity has 11 sector ETFs. Each one is a concentrated bet on a single slice of the U.S. economy. Tech, energy, industrials, financials, healthcare, utilities, you name it. The 10-year winner of this segment is FTEC, MSCI Information Technology. 23.19% per year. $10,000 turned into $80,492 over the decade. That's more than 8 times your money. The gap between FTEC and second place in this segment is over $43,000 from the same starting amount over the same 10 years. Now, FTEC isn't diversified, not really. Apple, Microsoft, Nvidia, Broadcom, the top 4 holdings are nearly half the fund. When those 4 companies do well, FTEC does well. Over the last decade, they did incredibly well. AI infrastructure, cloud build-out, smartphone maturation, chip demand, every major technology trend of the last 10 years funneled into those same 4 names. FTEC just held them. Now, there's another fund in this segment I have to talk about because it almost pulled off a heist. FENY, the Energy ETF. Over the last 5 years alone, FENY ran at 23.8% per year. That's bigger than FTEC's 5-year number. For 5 straight years, FENY looked like the overall winner of this entire video. But when you zoom out to 10 years, FENY drops to 9% per year, $23,674 from $10,000, 9th place in its own segment. The 5-year window caught the COVID crash, which led to the $100 a barrel oil rally. The 10-year window caught the 2014 oil collapse that came before it. This is why the crown in this video uses 10 years. 5 years can hide what a full decade reveals. Back to the ranking. Second place, FIDU, Industrials, 14.08% per year, $37,333. A solid number, but crushed by FTEC's enormous lead. The middle of the pack, FDIS, Consumer Discretionary, FNCL, Financials, FCOM, Communication Services, FMAT, Materials, delivered between 10% and 14% per year. The bottom, FREL, Real Estate, 6.1% per year, $18,078 from $10,000. Rate hikes crushed property values for half the decade. Real estate companies carry heavy debt, and their assets get repriced when borrowing costs go up. Now let's look at the 1-year picture. FTEC still leads at 61.6%, held the top of the segment on both timeframes. And there's FENY again. Remember 9th on 10 years? On 1 year, it jumped to second place at 44.4%. The same oil rally that drove the 5-year story reignited because of recent events. The big faller, FNCL, Financials, 4th on 10 years, dropped to 8th on 1 year, 15.8% return. Solid in absolute terms, but the weakest year among any sector that had a strong decade. Okay, there's one more fund that I have to talk about. It's not a sector, it's not a factor, it's not a dividend fund. It's the only fund of its kind Fidelity even offers, and it came in second place overall. A strange thing about Fidelity, they don't have an S&P 500 ETF. Let me say that again. The biggest broker in the world, no S&P 500 ETF. They do have one of the most popular S&P 500 funds on the planet, FXAIX, which tracks the S&P 500 with roughly $500 billion in assets, but it's a mutual fund, not an ETF. So if you want broad U.S. market exposure from Fidelity in ETF form, there's exactly one option: ONEQ, the NASDAQ Composite Index ETF. ONEQ delivered 18.46% per year. $10,000 turned into $54,415 over 10 years. Second place across all 58 Fidelity ETFs. The only fund that beat ONEQ was FTEC, and FTEC is concentrated tech, 4 stocks doing half the work. ONEQ, however, is broad, roughly 3,000 stocks across the entire NASDAQ. ONEQ tracks the NASDAQ, and most people associate NASDAQ with tech bubble risk, so they skip it. But the NASDAQ isn't just tech. It's tech-heavy, but it also includes Amazon, Costco, biotechs, and major growth financials. The same decade that made FTEC the champion also made ONEQ the runner-up. ONEQ just caught more of the broader market upside along the way. So, 2 winners from this video, different reasons. If you're going by pure numbers, the winner is FTEC, the MSCI Information Technology ETF. $10,000 turned into $80,492 over 10 years. Nothing else on the platform came close. But that return is built on a decade of tech doing what nothing else did. AI infrastructure, cloud, smartphone maturation, the whole story runs through 4 or 5 mega-cap companies. If those companies stop leading, FTEC stops winning. The tech tailwind is the setup, not the fund. The second winner, and honestly the more interesting one, ONEQ, the NASDAQ Composite ETF. It didn't just come in second, it did it by holding 3,000 stocks across the entire NASDAQ. Not a concentrated bet, a broad one. So if someone asked me to name one winner by pure returns, it's FTEC. But if someone asked me to name one winner by the most compelling story, it's ONEQ.